Dear all, MeDirect thanks you for joining this webinar, the 22nd in our MeDirect Talk series. This platform continues to feature insights from esteemed financial experts and asset managers, providing valuable perspectives on market trends and investment opportunities. At MeDirect, our commitment to delivering the latest updates on the investment landscape remains unwavering. We keep you informed through regular postings on our website and social media channels. Our dedicated team of experienced wealth advisors is always ready to assist you. We are delighted to welcome back Stephen Yu, a globally recognized fund manager who, in collaboration with Peter Hargreaves, co-founded Blue Whale Capital. Stephen brings a wealth of investment experience to our discussions. The focus will be on the Blue Whale Growth Fund, a global equity fund investing in large cap stocks in developed markets. Stephen will delve into the strategies his team employs to navigate macro uncertainties and identifying structural growth companies. The discussion will also explore emerging themes and selective opportunities in technology, generative AI, energy, and reshoring. To conclude this segment of the webinar, Stephen will share Blue Whale's market outlook. Following the presentation, we invite you to participate in a Q&A session moderated by Edward Malia, a relationship manager within the Blue Whale team. Throughout the session, please feel free to submit any questions you may have using the Q&A function available. Stephen, I'll now hand over to you to guide us through the undoubtedly intriguing content you've prepared for us.
Thank you very much. Good afternoon, everyone. So what I have prepared today is titled High Conviction Approach in an Uncertain World. And if you have joined our session this time last year, you would have recalled that I have mentioned several times about the new regime that we found ourselves in today, which are linked to geopolitical uncertainties. At the same time, inflation remain quite sticky. Hence, the level of interest rate would remain higher for longer. So what I thought we would do today is touch on a few companies that we have found they could continue to deliver outperformance or able to deliver more profits despite that we are in an uncertain world. Before we do that, just to have a very quick recap in terms of our investment philosophy and also our investment process. The investment philosophy is very simple, that we aim to invest into high quality businesses at an attractive price. And we invest into between 25 to 35 companies at any one point in time. There are 5 of us on the investment team, and we do all the research in-house. So we do not speak to any sell-side analysts, or we do not read any broker's research. So we go through all the primary sources from the companies. At the same time, we try to analyze competitors and also look at data that we can find that are relevant to our companies. And once we have done all that, then we will build a unique financial model for every company we have in the fund and try to make forecasts in terms of how much money our company would make in the next 3 to 5 years. And of course, this is also where our valuation exercise comes in. And this is also where our assumptions about where the world is heading, hence whether they might have a positive or negative impact on our company's earnings in the next couple of years, which then would play a role into our investment thesis. So this is what we do. And let's now kick off into what I prepped today. You might have recognized this slide because I have shared something very similar last year. And just to recap what we have been running in the fund this year is that number of themes or trends that we feel quite positive about. And I'm going to take you through some of these trends in more details later, such as artificial intelligence, digital transformation in certain software providers, reshoring opportunities, energy, nominal consumer spending in terms of high level of inflation, hence interest rate would remain higher for longer. And last but not least, I will also take you through some of the medical equipment companies that we invest into, such as Sartorius in biologics. So let's now kick off into our first company that everyone is familiar with, and I am sure that if you have followed us over the last couple of years, you would have heard my pitch about why we deem Microsoft as one of the highest quality company that we have in the fund. And if I take you through back to 6 years ago when we launched the UK onshore fund back in September 17, we have consistently invested into Microsoft throughout the last 6 years. At the same time, Microsoft have been featured on our top 10 holdings, which are the highest conviction part of the portfolio, very consistently over the last 6 years. And of course, if some of you work in the professional kind of space, then you will be familiar with Office 365, with the Outlook, PowerPoint, how Microsoft have now transitioned its business model from selling the software on a CD to now being subscription. So we are now paying a monthly fee, just like Netflix, to Microsoft, and which makes Microsoft very high quality in itself, that as soon as we stop paying the fee, then we no longer have access to the Office 365 suite. And of course, for professional workers like myself, that we would not be able to do any analysis on our company if we don't have access to Excel, for example, or PowerPoint that I prepped today. And of course, we all have to admire the management team, Nadella, who had led the company for the last almost 10 years, that he have successfully made the transition. So this is why we continuously like Microsoft as a business. Okay, so now if you go back to what happened in the last 5 years, that is the main story. So what is new? What is new to the Microsoft story that wasn't in place, let's say 6 years ago or even 2 years ago? That is artificial intelligence. So I'm going to take you through a few things about what we are talking about here. So on the back of generative AI, that we have already seen the first application called ChatGPT. I'm sure some of you might have used that already. They just celebrated their first anniversary recently. But of course, I mean, it's not about ChatGPT. It's about the generative AI technology within the artificial intelligence domain. And what Microsoft has done utilizing that technology is they are able to launch a Office 365 Copilot, which if you work in a very large company, you might already have given the privileged access to it over the last couple of months. For most of the people, or including us here, that will probably get access to the Copilot sometime next year. So they're rolling out the Copilot as we speak. But we have already seen strong evidence of feedback from users who are exposed to the Copilot, that it have transformed the way that they work. And just to give you very simplistic examples, is basically utilizing some sort of ChatGPT technology, but within our day-to-day work. So let's say if you're writing an essay in Word, they would be able to give you suggestion on the style that you're doing, how you can improve on it, or what are the pointers that you might want to include if you're tackling a particular topic. So there's a lot of things that at the moment you might need to switch from back and forth between ChatGPT to ask a few questions and then going back to your day-to-day work. That what Microsoft is doing is to blend this together. And of course, if you then translate that into Outlook, which is where we spend most of the time sending emails, communicating with our clients, then they would be able to come up with certain responses that are quite relevant. So instead of writing an email from the start to finish, that maybe they could help you to do that more efficiently. And at the same time, PowerPoint presentation, there's going to be new capabilities that you can create presentation quite quickly, and you can update the text or certain numbers or data quite efficiently, and also changing the style of the presentation without too much manual input. So it's all very powerful. But what does that actually all mean? So I'm trying to give you some context why we're so positive on this. If you think about what we have in the world as the knowledge workers globally, that there are about 1 billion knowledge workers in the world. So that is the number. If you look at LinkedIn, LinkedIn has about 950 million profile on LinkedIn. So that's it ties up with the numbers, about billion knowledge workers. If you assume on average, the knowledge worker get paid about $20,000 a year, which obviously for us sitting here in London or in Malta or in Europe, will get paid more than 20K, but people who are in the Far East, if you work in a call centers, then you get paid less. But let's imagine $20,000 a year. What you then get is people have been quoting about 6 months ago that this new AI opportunity is about $1 trillion. So how do you come to $1 trillion? Like it's a big number. You need to come up with the basis for that, and also where's the money is coming from. It's actually quite easy. What you need to do is just to reduce the global headcount in knowledge workers by 5%. So if you take 50 million people out of the 1 billion knowledge workers base, and 50 million multiplied by $20,000 of average salary, you get to $1 trillion. And we were debating within our investment team in London that we do reckon that the inefficiency in certain organization would be more than 5%. So you can easily take out even more, or maybe 5 to 10%. Or the other way to argue for this is you can improve efficiency by about 5%. So let's say no one has been made redundant, but if Copilot has been utilized properly, and then we are able to produce 5% more workload than before, then that would deliver $1 trillion of value. So this is how to justify that. But what Microsoft is doing is they are only charging about $30 a month for the Copilot seats at the moment. So in a year, we will be paying Microsoft about $400 a year, which is not a lot, right? And that's already a 50 to 100% uplift to what they are charging us today. So what they're charging us today is about probably between $30 to maybe $50 a month, and they're going to add on top the $30 if you want to use Copilot. Of course, from my understanding, that I think that is very conservative from Microsoft context, that I can easily imagine that if we can hire fewer people, let's say maybe new graduates, instead of paying them about 25 to 30K in London a year, let's say typically you hire 3 graduates a year in a bigger company. If you can hire 2 instead of 3, and then you manage to save 25K, Microsoft definitely can charge us a lot more money than $400 a year. So the potential runway for Microsoft is quite long. So then when we going back to our financial modeling, is once we factor this in terms of a new growth driver for Microsoft in the next 3 to 5 years, the valuation of Microsoft is looking very attractive. So this is how we think about Microsoft today. In the next couple of years, it's all about this new growth driver, artificial intelligence, Copilot, on top of what they have already established themselves. So if I then take you through to what is the back plan, or what is the infrastructure, which company is powering what I just talked about in terms of Copilot, ChatGPT, etc. And you would have heard me say this last year that we really like NVIDIA. So last year I have got a slide at the time that I believe that NVIDIA would become a $1 trillion company at some point. Of course, what I didn't realize at the time, which is about this time last year, was NVIDIA managed to get to $1 trillion within a 6-month period, which it reached $1 trillion in June this year. So NVIDIA has done exceptionally well. It was the largest position in our fund before the shares reacted very positively. And at the moment, it remains the largest position in the fund. So I'm going to take you through why we continue to like NVIDIA despite the share price has done very well. So this is just to illustrate what is different when we talk about artificial intelligence or accelerated computing. So on the left-hand side, you will see general purpose computing. And the general purpose computing is typically your the CPU on your PC, on your laptop, and of course we are doing different tasks, running Excel, watching YouTube, surfing the internet, and sometimes if you then use more advanced applications like Adobe Photoshop or maybe Bloomberg terminal like we do, that it can be quite slow because it's not good for multitasking. But of course, when we talk about generative AI or ChatGPT, it's very task specific and also it's very computational heavy in terms of how much data it requires to be computed in the back end. At the same time, giving you an answer or response quite quickly, right? Like you don't want to wait for, I don't know, like 30 minutes to get an answer. You want to get it now. And of course, if you have used ChatGPT before, you know how quickly it can give you that response. And you need to have very powerful computing power behind the scene to do that. So this is what NVIDIA does, is accelerated computing. And one statistic I want to leave you with, just to, if you remember this, for the next couple of years, then you know that we are just at the beginning of the journey. In the world today, within the global data centers, so including the enterprise data centers, at the same time, the cloud data center like AWS, Microsoft Azure, or Google Cloud, only about 6% of the data centers are being accelerated. So it's quite a small number. The other 94% are being run on some sort of CPU, which is general purpose computing. So based on our understanding that the penetration of accelerated computing would only go up from here. Of course, I mean, what might be the end number, we don't know, but we're going to track that quite closely. But the starting point is about 6%, which is almost nothing. And of course, what I've got in front of you here is Jensen Huang, who's the co-founder of NVIDIA, has deemed generative AI or ChatGPT being the iPhone moment for artificial intelligence. And if you believe that, that is really game changing, because going back to the very long time ago when we first had internet in late 90s or early 2000, that the internet speed was very slow. I'm sure if you have done an Amazon shopping experience at the time, it might take you an hour to check out and let alone to pick more than a few items at the time. So we haven't got the capability at that time. But of course, things have evolved since then. And then we have faster internet connection, right? Then we started to have the 3G, the 4G on your mobile phone, but we still haven't really utilized the internet properly until iPhone arrived in 2007 or 2008. And that is because iPhone has changed the way that we we interact with applications, that we are now doing it constantly, rather than I have to sit in front of my PC either at home or at work to be able to perform certain role or tasks. Like you can now do it either on your iPhone, your Android phone, iPad, anywhere in the world. And of course, on the back of that, a lot of our data has been generated through those interactions. At the same time, those data are being stored on the cloud, on the internet. So at the moment, you can imagine like everything about us or everything about yourself, anything that you have done, you are using certain, either you're using YouTube, you're shopping online, you are playing games, you are using online banking, or maybe making investment using MeDirect app, all the data being stored online. And of course, with all the data now being available online, then you put the AI on top, which is where NVIDIA comes in, where Microsoft Copilot comes in. Then there's a lot of potential that we can unleash on the back of that. But if we haven't got the data online, let's say generative AI or ChatGPT arrived 10 years ago, or maybe before the time that iPhone have started, we would not be talking about how powerful that is, because the internet connection are still quite slow. There's not enough data that you can actually take advantage of. And so what Jensen Huang is trying to allude to is now is the right time for generative AI, and this is like the iPhone moment for the next many years to come. And you would have seen how many applications or apps that's been written over, that's been on the App Store over the last 10-15 years compared to before. If you go to the next slide, just to give you some pointers on NVIDIA, I'm sure you're already quite familiar with it, that similar to Microsoft, that we really like the management team. We think Jensen Huang is visionary. At the same time, he's a very strong executor in terms of how he's carrying through his plan. And if you look at the quality of the company as well, that we would deem NVIDIA being very high quality. There's a lot of misconceptions about the company that people would think, oh, they are just selling a piece of hardware, which is called GPU. And if someone comes in, then you can easily replace whatever NVIDIA is selling with another product. It's not as simple as that, because the lock-in within the product is the programming language that they develop themselves called CUDA. And in order to utilize the capability of the GPU that NVIDIA produce, you would need to program the chip using CUDA. And in time, AMD is going to come out with their own GPU. That would be a completely different programming language. So the way to think about this is a bit like you and I, we could sit down together and we want to start a new app store, a mobile app store, to compete with Apple iOS and Android's app store, Google App Store. It's not possible, because no developers are going to write any apps on our for our platform, and then it become a chicken and egg scenario, that you want people who know the language, who have been studying the language when they are in university, or a lot of research being done on it. So by the time you have different applications, like a lot of people are going to jump on board to then build further improvement on that. So we really like that stickiness of the capability, and it's not easily replicated if another company is just to come out a faster product. Of course, that's not happening at the same time, just because NVIDIA has a first mover advantage, or they have been doing this for the last 15 or 20 years, and the balance sheet is very strong. So if I now take you through to other opportunities that we also like within the fund that are a bit different, like this is a company that you might not have heard of before, is Sartorius. So we do invest into medical equipment companies. We do not do biotech companies just because it's very difficult to get very difficult to assess whether our drug could be successful or not. But we do like the biologics sector, that we think on the back of either AI or people who are working on biologics, which is how we have come across the COVID vaccine that's being developed using biologics, that we really like that development. But what we are not investing into is a particular drug that could be successful or not. We are investing into the company that are actually making the equipment, so then the biologics could be produced. So this is what Sartorius does, that they have a complete portfolios of bioreactors, single-use bags, filtration products, and so basically, if you need to produce a biologics, you would be exposed to Sartorius kind of products, and from a very early stage. And what is quite important at the same time, which goes to the quality of the business, is when you have to get your drug approved with the FDA in the US, that you would need to spec in how you're going to produce a drug. So let's say if you have already factored in that you're going to use Sartorius products to produce your drug, once it become approved, then you cannot change that manufacturing process after the drug being approved. So you can imagine, once a drug has been approved, that Sartorius equipment would stay with the drug for the next at least 10 to 20 years until its patent got expired. So that is what makes the business very long-lasting and high quality, that we really like. And at the same time, the management team is very good. Next slide. But what is this all about, the biologic segment? Like, why do we really like this? So if you look at the production level today, which is I have a chart, just a very small chart at the bottom, that you can see that in today's context, there's only 1/3 of the drugs that being in the market are biologics. The other 2/3 are conventional way of making it, mostly chemical based. And if you look at the pipeline, that the drugs are under development, which is not yet in the market, you can see that over time, biologics in terms of proportion of the market is going to go up dramatically. And at some point, I won't be surprised that the biologics, which works a lot better, of course, is more personalized, but it can become a much bigger part of the market than today. And it could even take more further market share from the conventional way of making drugs. So it could be even more than 50%. At the moment, you can see the chart below that is based on our assumptions. So the yellow line going up from 30, just short of 35% to about 41%. That's based on the assumption. We think in 5 years' time, the market would get to about 41%, but it doesn't mean it will stop at 41%, because it could go up to 50 or 60, as long as it's a much better method of delivering us the treatment. So we really like this. And of course, if you look at the quality of the business, which we already discussed, that is not heavily exposed to the macro environment, which is quite challenging, right? So by pharmaceutical companies, or how a drug could be successful or not, in terms of in the form of developments, that is very it's not going to be impacted heavily by what's going on in geopolitics, for example, which is something that we like. So it's a bit of idiosyncratic exposure that we have through Sartorius. And if I take you back to what we just, the slide that I've shown you at the beginning, that these would fit into a couple of themes that we just talked about here. And just to complete the journey, that you might have heard me say this last time already, that we still like reshoring. Lam Research is on our top 10 holdings. We do believe that on the back of geopolitical uncertainty in Asia, that we would have more foundries. It's going to be replicated in the Western world, and this is what we call silicon sovereignty. And you would have seen projects being announced to build new foundry in France, in Germany, even UK is trying to get involved, and a lot of foundries are being built in the US. So we are trying to de-risk away from Taiwan. If you follow what's happening in Asia over the last few years, and Lam Research, similar to Sartorius, sells the mission critical equipment in order to produce a silicon chip. So if we have more foundry being built, funded by the government mostly, then they are going to sell many more of the equipments in the next few years than the last couple of years. So this is what we like, that on the back of the geopolitical uncertainty, that Lam Research is actually going to make more money, which is quite interesting. And the other one, which is something fairly new to us, because we only invested into this company this time last year, is Canadian Natural Resources. This is our only energy company we have in the fund. This is new to the fund, as in we have not invested into energy company for the last 5 years before this stock that came to life. And the reason being is we believe that the world have changed, that we do reckon that oil price is going to remain at a higher level than the previous cycle, despite a recession or slowdown might yet to come. And this is just on the back of the geopolitical uncertainties in the Middle East, the power of OPEC, or how Russia is weaponizing the oil reserve. The company that we have invested into, that we would deem Canadian Natural Resources being one of the highest quality company within the energy domain, that it not only that it has a very long life reserve in Canada with about 30 to 40 years. At the same time, the average cost per barrel of production of oil is only about $30. So let's imagine, if oil price is going to remain at $70 to $80 for the next 3 years, Canadian Natural Resources would be able to generate a lot of free cash flow back to shareholders through dividends or buybacks. Of course, we do not forecast oil price. That is a very difficult exercise to do. But in the scenario that oil price, for some reason, go even higher, then of course Canadian Natural Resources would make even more money than what we have assumed. But even based on a very conservative assumption that, assuming oil price remain unchanged, that the valuation is looking very attractive. And the last one, which I would not have time to talk about now, but if you're interested, I would tackle this during the Q&A, is Charles Schwab. We do expect on everything that we have just discussed that interest rate is going to stay higher for longer. We could expect a reduction in interest rate in the US next year, but we are not going back to the 2% regime. So let's say a good scenario would be the interest rate in the US is going to come down from 5.5% to about, let's say, maybe 4.5% or 4%. That's already very helpful to the market, but we're not going back to the 2% regime anytime soon. So Charles Schwab is going to benefit on the back of that change over time. So the last slide that I have got here, before we open up to Q&A, is this is our outlook for 2024. To be fair, that this is the same outlook that we had at Blue Whale this time last year. So our view on the world have not changed, that we believe that the interest rate risk has peaked, which is basically the first 6 months of last year in 2022. And if you follow the Blue Whale Growth Fund performance, that we have started to recover in performance since July 2022. So while everyone is reading a lot of negative headline about the world or interest rates still going up, as far as the financial market is concerned, that a lot of expectation changes in interest rate level that have been almost completed during the first 6 months of last year in 2022. So this time last year, in the second half of last year, or Q4 last year, that we have already said that we believe that interest rate risk is a lot lower than before. Of course, that on the back of that, what we're tackling with is recession risk. At the moment, the data in the US, at least, is not suggesting that we're going into a severe recession. If you go into the definition of a recession, it only means a 2 quarters of negative GDP growth. So let's say we do go into a slowdown mode called recession, that the GDP growth goes down by 0.5% or 1% a quarter for 2 quarters. That's all fine, like that's very manageable. What people worry about is a severe recession, that we might have a repeat of the pandemic or what happened during the global financial crisis back in 2008 or 9, that the GDP would contract by maybe at least a few percent per quarter. And of course, an unemployment rate could go up to about maybe 5 to 10%. And that would be quite a worrying scenario. But all the data that we have seen is suggesting a soft landing. But a soft landing still doesn't mean it's a bright scenario, because inflation remains quite sticky, which means that we would expect a stagflation scenario. We remain cautious on consumer discretionary spending, that our wallet would continue to be squeezed by high energy bill, which in the UK, that is the case. Higher mortgage rate. This is a function of level of interest rate staying high for longer. So if you need to remortgage your flat or house, you're going to pay a higher number in the next couple of quarters. And of course, at the same time, the inflation number is still not that low. So we need to be more selective in terms of where we spend our money. So overall, when you really look into the market, equity market, people are generally quite cautious. I think it's right to be the case, because if you look at the S&P 500 equal weight index, so not the market cap weighted index, is only up about 5% as of today. So a few days ago, it was flat, it didn't move. But when you look at the S&P market capitalization weighted index, or NASDAQ, or even maybe the Blue Whale Growth Fund, that we have some of these stocks that have done exceptionally well, that is up a lot higher. But it's right to say that most of the companies that are exposed to the macro environment that we just talked about, that they shouldn't be going up in terms of the share price, because it's more difficult for them to make money in the next couple of years. So what do you do in that scenario? To us, you want to invest into high quality businesses, because this is how this company could protect investors through a recession, if we do go into a severe recession. And the quality of the business should be able to outweigh the negative during a recession. Of course, then you look at the balance sheet. Most of our companies are net cash. So if you're net cash, you're not worried when you're going to recession, or if interest rate going to stay high for longer, because you don't have the debt to be repriced. You're not going to pay a high level of interest rate because you have a lot of debt on your balance sheet. High gross margin, strong pricing power, and at the same time, if the company can also make more money, because there's certain key drivers like artificial intelligence, like Copilot, or reshoring opportunities, or like Sartorius, there's some underlying drivers within the biologic space, or maybe Canadian natural resources that are going to make more money on the back of a high level of oil price, then yes, those companies would then end up doing a lot better than rest of the market or most other company that doesn't have that exposure. So this is what I have prepared, and happy to take any questions. So the last slide is just the risk warnings, and I will pass it back to Ed.
Thank you very much, Stephen, for your questions. Just a brief introduction to myself again. Thank you, Ingrid, for introducing me earlier. I'm Edward Malia, and I'm a relationship manager here at Blue Whale. Just a quick one in case you want to refer to them. There's 2 handouts attached to this presentation where you can refer to the full since inception performance of the Blue Whale investment funds, Blue Whale Growth Fund, to the ICAV. So please do refer to that. And there's also a summary of our top 10 holdings. There have been a few questions which have come in. If you'd like to keep on submitting questions, there is a questions tab where you can just submit live questions. So please go ahead and I will ask on your behalf. But to kick off, I'll start with one which Stephen discussed briefly, and it has to do with the performance of the Magnificent 7 stocks in the S&P. They have done very well this year. Do you think that it's now time to invest in the rest, in the other 493 stocks?
I think the short answer is no, but I will give you more pointers to that, because it's not as simple as that. So firstly, when you look at the Magnificent 7, the 2 companies that we just talked about that we really like out of that is NVIDIA and Microsoft. And there are a few companies that we have no idea why they have gone up so much, and we are not buying them. We have some concerns about the business model, whether artificial intelligence is going to be as game-changing for those companies than, let's say, Microsoft, NVIDIA. And those names are Amazon, Alphabet / Google, or even Tesla. We have no idea why they have gone up as much as Microsoft. And so we can come, I mean, we are not going to buy those companies. But as far as NVIDIA or Microsoft is concerned, we are very happy with what we would expect them to do in the next couple of years. For the rest of the market, the other 493, that is difficult, because as I just outlined about the macro environments, most companies are either exposed to some geopolitical uncertainties. If you are selling or making your products from Far East and you're exposed to geopolitics, you might need to reshore. Reshoring means it's expensive, that you need to then set up a new factory, which is going to take time to build, and then you need to train people to do it, and maybe then you need to invest into logistics. It's not an easy exercise. You're being exposed to those uncertainties. At the same time, that if you're consumer-facing businesses, whether you're a technology company or not technology company, we are quite cautious about those companies. And most companies within the market are consumer-facing, and this is the new world that we would remain, our discretionary spending would remain being squeezed, just because of what we just talked about. So in order to pick companies that can do well out of the 493, it's not easy. I mean, we do have a couple. We have MasterCard, Visa, that will be part of the 493, Canadian Natural Resources, Lam Research, and some others. But I wouldn't say that you can just invest into the market and say, okay, why don't we sell everything outside of the from the Magnificent 7 and then put all the money back to the other 193, because I think that's a lot of traps within the 493. At the same time, some of these companies are also heavily indebted, which then they need to pay a high level of debt servicing costs in the next couple of years.
Thank you, Stephen. We have another question which has come through, which is in relation to maybe the area of the portfolio or any particular stock which you remain most excited by standing here at the end of the year and going into 2024.
Well, I mean, I'm excited on most stocks, and because I think to start off with, NVIDIA remain, or NVIDIA together with Microsoft remain our 2 largest position in the fund. So I already talk about them, that I remain quite positive about them, despite that the share price performance has reacted very positively in 2023. But at the same time, that the two companies that haven't done well for us within our top 10 this year is Sartorius, that we just talked about. They have been through some issues in terms of cyclical inventory kind of management issue, which we don't think is material, but the shares has reacted quite negatively. At the same time, Charles Schwab, the company I just mentioned, that they went through some issues when we had the regional banking crisis in the US, the SVB, if you remember, back in March this year, that the share price has been hit accordingly. Recently, we have seen a bit of recovery from Charles Schwab, if you follow the shares. And so I would expect that this company would do well in 2024, because whatever happened this year is more cyclical than material changes in the business model. So it's a bit of a hiccup, but they could recover quite well in 2024. It's very difficult to pick one stock out of the 30 stocks because we all like them. But if you look at our top 10, I think that does reflect what we're seeing in the world, that those companies could do pretty well.
Thank you, Stephen. And a follow-up question on that. How do you and your team generally react when there is an underperforming stock? Will you act swiftly to remove that stock from the portfolio? Will you add to it? Maybe just give through a live example of one of the stocks you mentioned in the previous question.
This is a very good question. So if I take you through slightly the journey, which is quite interesting about NVIDIA. So, and we started investing into NVIDIA back in June 2021, so about more than 2 years ago now. And NVIDIA's market capitalization was at about $500 billion. And at the end of 2021, NVIDIA's market cap peaked at about 800 billions. Okay, this time last year when we talk about NVIDIA, or when I was trying to kind of justify why we still like NVIDIA, that the shares has come down a lot for mostly for the reason that interest rate has gone up, rather than NVIDIA's making a lot less money or there's a new competitor coming in. So NVIDIA's market capitalization troughed at around 300 to 400 billion from 800 only about 9 months ago, this time last year. And of course, we really focus on fundamentals of the business, hence all the fundamental research that we just talked about. And we continue to buy more of the shares of NVIDIA at a very low valuation at the time. And of course, by the time it got back to $1 trillion from a low base, that we have managed to make a lot of profits or deliver a lot of performance for our investors over the course of this year when the shares started to recover. So, but of course, there are other scenarios that companies that have gone down in share price terms, and with its fundamentals or the business model being challenged or questioned, there's a question mark about whether the business model remain high quality, then we want to exit those companies, because it's only good that you back your conviction on company that you believe is going to survive, is going to win over time while they went through a bad time. But you can't just put good money into bad investment or bad asset, because then you might not get your money out at the end, it might go to zero. So that is exactly the opposite of what you should be doing. So if you know your company quite well, which is what we think we do, then you can back your company by buying more of those shares at a lower valuation. And this year, what we did, so using 2023 as an example, that we have been buying a lot more of Sartorius or Charles Schwab when the shares has gone down a lot in between January and now. So we are backing our conviction, and hence you continue to see this company remain on our top 10 holdings. And that was an active decision for us to buy more of those shares to keep them at the weighting that we want them to reflect.
Thank you, Stephen. I've had a couple more questions come through. Do you believe that ESG factors have a significant impact on long-term investment success? So how do Blue Whale incorporate ESG into our process?
So we are not running a high impact fund, as you know. So we don't make active decision, or we don't seek company that are actively going to make a positive impact in the world in terms of, let's say, environmental issues or maybe social issues. Like, this is not what we do, but we do deem ESG as business risk factors, right? So if there's certain factors, either environmental, social, or corporate governance, that could have a negative impact to the business model, which then translate into the company delivering a lower level of return on invested capital back to investors, then we would not like those companies. And this is exactly the opposite of what we do, that we would deem these companies to be low quality, right? So if you do it on a negative screening, which is not what we're doing, but when we talk about a company being high quality, they are already doing most of those things correctly, or they're tackling those issues. They would have good corporate governance. They're not irresponsibly destroying the environment while they're manufacturing certain machinery, or Sartorius making the machine. That we would not expect them to have a material negative impact to those issues. So this is how we think about this. But I think the one comment I would make on this is, I think the world have maybe shifted in a different way over the last few years. Of course, the ESG issues are important, but you can't really use the ESG, you can't really wear an ESG hat and say, okay, these companies are doing very well on ESG, and they would become very good investment. Like, I would disagree with that thesis completely, because you can have a company doing very well across all the issue, but doesn't mean the business model could help the company to make a lot of money for shareholders. Like, that's a bit of like a detachment, that you can do some things very well, but doesn't mean it's a good investment. So I think from our perspective, it's like, we want our company to do well. We want them to take ESG issue very seriously, but it's a combination of the two that make them a good investment, rather than you take one and try to overlay that, which I think that's why some funds has not done that well in the last couple of years, while they have worn the ESG hat.
Thank you, Stephen. And are there any specific factors or events that you believe could significantly impact the markets in the near future? We don't have a crystal ball, but is there maybe a risk which the team is worried about, which you're taking into consideration?
So I would say that it's two things that are probably the most difficult. I mean, would have a most negative impact to us on a high level. Firstly, of course, I did share our view on interest rate, that we think the interest rate risk in terms of interest rate going up significantly higher from here is very low at the moment, based on all the data we've seen. But of course, I mean, you can't just rule it out completely. And in the scenario that interest rate continue to go up from here, from 5%, and let's say this time next year that we're sitting here, the interest rate have now become 8% in the US, or maybe in Euro zone, that it become 5 to 6%, is a big worry for the equity market, right, or fixed income market, or any asset classes. And that's what we had experienced in the first 6 months of last year. So that would be the biggest risk to our strategy, which I would deem that risk to be quite low as we speak today, but that is still a risk, right? It's not gone, it has not disappeared yet. The other risk, which is something that you can't really factor in, but in terms of the positioning of the fund that we have tackled, that is geopolitical uncertainties. We have already seen two conflicts over the last 2 years. Right, we had the Ukraine crisis in 2022. We had the Middle East conflict as we speak over the last couple of weeks. I mean, who knows what's going to happen next year? And on the back of what I have kind of expanded on earlier, is we do expect geopolitical uncertainties to continue in the next 5 to 10 years. Like, we are in a new regime that is deglobalization. Like, we are less friendly, like most countries, Western world, with the emerging markets or different regime, that we are less friendly than before. We become more protective in terms of what we have, how we go about doing businesses, how we think about whether we're going to just operate in the way that we did before the pandemic for a long time. That you will recall how China have become very big and powerful was on the back of China joining the WTO. So everyone was friends, and of course Russia was also a very close friend with Germany, with France, with Europe. That's not the case anymore. And how we can become friends again, it could take a long time. And as long as we are not friends, then things might happen. And this is something that is very difficult to factor in. But it's important that you position yourself if it does happen. So hence a couple of stocks that we have in the fund that would do quite well on the back of that. Of course, we don't want to see that happen, but it's something that you need to keep in mind as an investor.
Thank you, Stephen. And the last question, and we've nearly run out of time. So what I'll say is, how do global monetary policy decisions impact your investment outlook, and how closely do you monitor central bank actions?
We do monitor it quite closely, but I think the difficulty with that is we don't have a crystal ball, because it's just one of those things we have learned from 2022. Of course, I mean, we talk about 2022, we did not do well in that 6-month period, because we had a crystal ball knowing that interest rates are going to go up to 5% in the US, not 3 to 4. That's my maybe initial expectation, let's say back in 2021. Then we might have done something different. But of course, this is something with hindsight that you can look back, but it's not like we can actually foresee that happening. I think what is very important from a bottom-up stock picker's perspective, or as far as do well growth strategy is concerned, is you want to pick companies that can do well over the medium term. And I would recall that this time last year, in 2022, like even Microsoft shares has gone down 25%. But then before that period, for the good 5 years before Microsoft shares was down 25%, it's gone up 200 to 300% since we started investing in Microsoft. But then there was a period of time for about 6-month period that Microsoft share was down about 25%. So what do? Do you try to time the market or time Microsoft shares because you believe there's some central bank's action that might impact that? No, you want to be able to hold on to the shares, and given the opportunity, you want to buy more of those shares, which is what we talk about on NVIDIA. And over time, if you look at Microsoft now, is exceeded what they have achieved before. NVIDIA is now higher than the peak that they have achieved back in 2021. So over the medium term, we believe that share price of a company would reflect the earnings power of that business. And if the earnings power of the business remains strong and continue to grow with new drivers, growth drivers, then the share price should reflect that. But in between now and then, what's going to happen in the next 6 months? Well, what the central banks are going to do? Is it going to have a negative impact on the share price? Of course, it could have, but that is a bit out of our kind of control, that we are investing in companies that can continue to compound the rates of cash that they generate at a higher rate that we could make as an investor. So I would rather Microsoft continue to expand their capability, or NVIDIA to expand their capability, than paying us a dividend. Do you see the difference? Like if they say, okay, I'm going to pay you back 10% of the cash flow, because then we need to find another company that can do it as well. I would rather NVIDIA to reinvest most of the cash flow back to the business and generate a high level return. And that's how you win as an investor over the medium term.
Thank you, Stephen. So that's the last question of today. I'll hand back over to Ingrid, who might have some concluding remarks. and I'll sign off here.
So Stephen and Edward, I really appreciate your time today and the insightful information shared. I'm confident our audience found it as engaging as I did. A heartfelt thank you also to everyone who participated in today's session. Should you have any additional questions, our team of advisors is at your service. For more details on the fund that we discussed today, you can also visit our website, medirectalk.com.mt, to be able to get any information you might need. Thank you, everyone, and have a nice evening.